how do you know what to hedge? What is hedging? Can you protect a profit or minimize a loss or lock in a loss without knowing what your position is? No. You can't just flip a coin and then buy and sell futures and hope that that works. I got a 50-50 chance of being right. That's better than I usually do in the rest of my life. I can live with that. No, it's not a good approach to trading. So before we can start talking about hedging and risk and using swaps and options and futures, we have to understand what is our position, what is our risk. So the principal things we talk about in oil are short and long. So what does it mean to be short? What does it mean to be long? There's a couple of different ways. We'll start with these. Okay, Europe is short distillate. Now, is Europe a trading company? Are we talking about the EU here? So does that mean that Europe has sold distillate that they don't own and need to buy it back? No. What does it mean when we say Europe is short distillate? Consumers use more distillate in Europe than local refiners make, which means they need to import. So that market is short distillates. Refiners are long the margin. What is the margin? Is the margin a product? No, it's a financial relationship, isn't it? It's the difference in price between crude oil and products. That's financial. So now we're talking not about an overall economic assessment, we're talking about a specific financial position. What does it mean that refiners are long the margin? When you're long something, it means you own it and you want it to go higher. So how high would refiners like product prices to be? As high as they can go. And how low would they like crude oil prices to be? As low as they can go. So they would like oil for free and products at $1 million a ton. And the cost of running the refinery, a couple of dollars a barrel, maybe. They might even pay $5 a barrel with that kind of margin. So they're long the margin. The farther apart the margin goes, the more money they make. So they're long. He is long a term contract of Bonnie Light. What does that mean? Does he own Bonnie Light crude oil at a fixed price? No, the term contracts don't trade on a fixed price. They trade on an OSP, dated Brent plus a premium that changes every month. What this means is he signed a contract for a cargo a month, which means he has to go to Nigeria once a month, lift a cargo, and do something with it. So he's long that position. She is short jet fuel into the Thames. What does that mean? She sold a cargo that she doesn't own yet. She has to go out and find that cargo and deliver it to them. Did she sell at a fixed price? We don't know, probably a floating price, but she doesn't own the oil yet. She promised them the cargo, contractually, and she has to go out and find it. Okay, so this is one of the ways we use long and short. Now, when we're talking about hedging, we're not talking about hypothetical situations where you have to go lift a cargo a month, fixed price, floating price, we don't know. Financially, we're talking about dollars and prices. So here, we're long or we're short if there is a price assigned. If there's no price assigned, we're neither long nor short. So if we have a cargo on a floating price that's going to be loading 5 days around BL in a month, do we know what the price is yet? No. So we're not long and we're not short that price. We're long the position. We're going to have to load the cargo and do something with it, but we don't have price risk yet. So, long. You are long if you make money when prices go up. You are short if you lose money when prices go up. If you don't care where prices are going, you're neither long nor short. You're simply neutral or balanced. When you get into complicated positions, trading spreads, trading relationships between products, then it's not so clear what you're long and what you're short, or if you're long or if you're short, or how your positions work. And what matters is you need to know what you're long and what you're short so you can figure out what? How to hedge, how to protect yourself. So if you're long and the price goes up, how do you feel? If you're long and the price goes down, sad. If you're short and the price goes up. So you sold someone a cargo, 1 million barrels of jet at 60. You sell me 1 million barrels of jet at 60 that you don't own yet. So you promised me $60 jet, 1 million barrels worth. What do you need to now do?
Buy.
You need to go and find that jet. Now, would you like to buy it at 50, or would you like to buy it at 70? 50. You sold to me at 60, you'd like to buy it at 50. So if the market goes up to 70, how do you feel?
Sad.
Sad, okay. And of course, the other way around. Right. And then, of course, if you don't care one way or another, you're neutral. Suppose you're going to load a cargo of, we'll stick with our 1 million barrels of crude oil. You're going to load 1 million barrels of crude oil on the 15th of February. Are you long or are you short? You don't know. There's not enough information. What if I tell you you signed a deal at $60 a barrel to load that cargo? Are you long or short? You're long. When did you get long 1 million barrels of crude oil at $60? When the cargo loads, when you fix the ship, when? The moment you fix the price. If you did the deal at 9 o'clock in the morning and you agreed to buy 1 million barrels at $60, you got long 1 million barrels at $60 at 9 o'clock in the morning. And it doesn't matter when the cargo physically will appear. Okay? What if you have a cargo that you loaded last week and the price is the average price published by Platts during the month of March? And it's sort of sailing around the water. Do you have a risk yet? Can you hedge it? You don't have a fixed price yet. For the time being, you're neutral. You haven't sold it, and you haven't bought it in terms of having a fixed price. You have a contract, but the contract price hasn't been settled. So in this case, you'd be neutral. So when the oil is physically exchanged, doesn't matter. What matters is when the fixed price appears. The entire fixed price or part of the fixed price. Let's say you're loading a cargo based on Platts, and it's 5 quotes around the bill of lading date. The bill of lading is on the 3rd, which is a Wednesday. So the ship is going to start loading and finish on the 3rd. So what pricing days will we use in Platts? 1st, 2nd, 3rd, 4th, and 5th. If this is 50,000 tons, what is your position from a price point of view? Do you care where prices are going? This is the only thing you have. You haven't sold anything yet. This is the only thing you're buying this cargo. On the 30th of the previous month.
Oh, you bought it on the 30th.
You did the deal whenever. It doesn't matter what you did the deal. The pricing, the price that you will pay for this cargo is based on the loading date, based on the bill of lading date, 5 quotations around the BL date.
Okay.
And the BL date is going to be on the 3rd. Okay. So on the 30th, do you have any price risk?
Yeah.
Do you know what the fixed price, what any of your fixed prices will be? What the final price of your cargo is?
No.
No. What about at the end of the day on the 1st? Do you know the final price for your cargo?
No. Yeah.
No.
For one.
Well, okay. Let me ask you this. What's the difference between buying the average of these 5 prices for 50,000 tons or buying 5 separate deals for 10,000 tons on each day?
Okay.
It's exactly the same thing, isn't it? If you're combining it all together in one ship, it doesn't make any difference. So when you're buying a cargo pricing over 5 days, it means that every day you're picking up 10,000 tons. At the end of the day, at what time, by the way?
4:30.
At 4:30 in the market that you're operating in, at 4:30 you're going to have a really, really good idea of what Platts is going to publish on the day. Within 50 cents if you're actually following the market. Which means that you get long on the first day 10,000 tons at 4:30. you have a fixed price for 10,000 tons at 4:30. What about the next day? You pick up another 10. So at the end of the day, you're long 20, so on and so forth, till finally you're long 50,000 tons with your final fixed price. But every day you're picking up an additional 10,000 tons because every day you're getting 1/5 of your price, which is the same as a fixed price on 1/5 of your cargo.